Looking at the price here, we are up at some amazing territory here. We're right near the highs while this is being recorded. Gold and silver peak and the dollar survive. Now, history is repeating, and it is interesting that this breakout is coming on approximately the same day, 40 some years later, as it did back in November of 79. And we may be off to the races. So it's possible by next January we could be seeing some very, very high prices in silver. But to account for the expansion of the currency supply, to account for the growth in GDP, perhaps we need to move this decimal one place to the right.
Mike Maloney describes the current silver surge as a moment that echoes one of the most dramatic chapters in monetary history. Prices have pushed into extraordinary territory, sitting close to fresh highs, and the pattern emerging today mirrors the explosive breakout of late 1979 almost to the exact week. Back then, precious metals rocketed as confidence in the currency eroded, and Maloney notes that the same structural pressures, monetary expansion, debt saturation, and weakening real value of the dollar are now aligning again. With currency supply far larger today and GDP dramatically expanded, he argues that fair value adjustments may require shifting the decimal point one whole place to the right compared with historic peaks. This suggests the possibility of exceptionally high silver prices by early next year if momentum continues. The setup is powerful, the macro forces are undeniable, and the window appears to be opening once again. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Silver's bull run hit a CME circuit breaker, but the cycle won't stop. And basically, Ben Rickard is putting out the evidence here of why this cycle won't stop. And the great part is down at the end here. He says, money is unraveling. He means currency here. Money is unraveling. Confidence is eroding, price signals are returning, and silver, which is money, is the underestimated monetary metal. Monetary means money, is leading the way. The bull run didn't pause, the exchange did. That tells you everything you need to know about where this cycle is going. And he has nailed it here. Looking at the price here, we are up at some amazing territory here. We're right near the highs while this is being recorded. But if you look at this, the orange line is the 50-day moving average, and look at the support that it has given this all the way across. The green line is the 10-day moving average, and the 10-day moving average, you'll notice on uptrends like this, that it gives great support on uptrends, and when it breaks it, we're in a little pullback. Well, it's given great support now every once in a while. Gold and silver and almost everything else in the markets needs to come back and visit its 200-day. But that is a much more rare event. So we've visited the 50-day 3 times here. We've visited the 50-day. It's worked off its overbought condition. So now it's sort of free to run. And it looks like it is. We've done a breakout. And this is we are over 3% above the previous highs here. And that is confirmation of a breakout. The main point, though, isn't to pay attention to all of the short-term noise. Yes, some servers probably overheated. It probably wasn't silver breaking the market, but I don't know that. I can't confirm it. Maybe it was silver, and maybe this is all an excuse. I doubt it. But because they didn't pull the other shenanigans yet. I'll get to some even greater shenanigans that they can pull when I do a comparison of today's market to the 1970s. But keep an eye on the big picture. In September, I drew you these charts. This is the big 45-year cup and handle pattern that I believe I was the first one to identify, but it hadn't broken this yet and confirmed that we were off to the races. Here it is in linear format instead of log, just to show. This is the big old beer stein. Cheers. But in keeping an eye on the big picture, I want to compare this to the 70s bull market. So here you've got 1979, the last year of the 70s bull market, because it ended January 18th, 1980. So this is January 19th, 1980, and it was 49.45. All of these, because Stock Charts doesn't have the intraday data, but that was the close. It actually reached 52.50 intraday. But if you look at what's going on here, it was rising and rising and rising. Now the Hunt brothers had a major concentration in the silver market, and it is my total belief that because the Federal Reserve was involved in some of these decisions, Paul Volcker, but it is my belief that gold was in a runaway, and that threatens the survival of the dollar. The dollar had only been a fiat currency for 8.5 years, and they were trying to get gold under control. But gold is a huge market. It takes a lot. Now, in the silver market, it was I don't know the exact size back then, but it was around 1/300th of the size of the gold market, something like that. There are times, though, where it's only like 1/30th of the gold market instead of 1/300th. It was much easier to control. And then the Hunt brothers had a major concentration. So they had basically a scapegoat, and they had somebody that had a major concentrated position that they could break if they kept on changing the rules. So they went up and they kept on increasing margin requirements and increasing margin requirements. But still, it did a breakout. So here we have roughly $6 at the beginning of 79. And then we've got 1750, higher than 1750 here in September. And then at the end of November, just like today, this is, what was that, 43 years ago, something like that. It did a breakout and started a run, and they would increase margin requirements and increase margin requirements. And then they put in position limits. A futures contract is 5,000 ounces. They put in a position, you could only hold so many futures contracts. And that caused major players that have very large positions to have to dump a whole bunch of their silver, but that didn't stop it. And it kept on running and running and running. And then they finally had to put in a rule, liquidation orders only.
Mike Maloney lays out why silver's surge is far more than a technical event. It signals a structural shift in the monetary cycle. He highlights how the latest spike was halted not by the market itself, but by a CME circuit breaker, a moment that underscores the depth of real demand. As he notes, money is unraveling, meaning confidence in currency is weakening while genuine price discovery returns. Silver, long underestimated as a monetary metal, is now leading the move as primary support levels continue to hold. With the 10-day and 50-day moving averages reinforcing the broader uptrend, the metal has cleared previous highs with conviction. Maloney argues the real story is the long-term breakout pattern now aligning with the explosive setup last seen in the late 1970s. Let's get into the interview.
The government and the commodities exchange broke the Hunt brothers with all of these changes, especially the position limits. And this actually caused the bankruptcy of Engelhard Refinery. It was a huge scandal, and there were trials after. But they couldn't prove anything. But during these trials, it was found that most of the people running the commodities exchange were heavily short silver, and they were being driven. Basically, if they hadn't stopped it, they eventually would have gone bankrupt. So the people that make the rules of the game were short silver, and something had to be done. But also, gold was in a runaway, and we came very close to losing the U.S. dollar back in January of 1980. And so if you can crush the silver, a whole bunch of people that trade silver also trade gold. All of the brokers that do gold and silver trades do both. In the commodities exchange back then in Chicago, in the Chicago Mercantile Exchange, there were pits, circles of guys, doing hand signals and screaming at one another and doing all of this trading. And the silver pit is right next to the gold pit. And don't you think, like on a bathroom break or something, they talk to each other? And don't you think that the gold guys go, wow, if they can do that to silver, we're next? And gold and silver peaked on the same day. They put in a rule called liquidation orders only on silver, and that is a rule that says until this rule is lifted, the price of silver can only go down. It means that you can close out existing futures contracts, but you cannot buy a new futures contracts. If there are no buyers and all you've got is sellers closing out old deals, that means the price has to fall, period. And so this is a rule that says until this rule is lifted, the price must fall. And don't you think the gold traders go, oh my God, we're next. And they all said sell, and gold and silver peaked, and the dollar survived. Now, history is repeating, and it is interesting that this breakout is coming on approximately the same day, 40 some years later, as it did back in November of 79. And we may be off to the races. So it's possible by next January we could be seeing some very, very high prices in silver. But to account for the expansion of the currency supply, to account for the growth in GDP, perhaps we need to move this decimal one place to the right.
The historical pattern that shaped the silver market in 1980 is resurfacing, and the implications are hard to ignore. Mike Maloney explains how the Hunt Brothers episode revealed the power structure behind futures markets, where rule changes and position limits were used to halt a rising silver price. Back then, the shift sparked panic across trading pits as both metals peaked simultaneously, saving the dollar at the last moment. Today's environment carries an uncomfortable resemblance. Silver has broken out on nearly the same calendar window as it did in late 1979, and the pressure beneath the surface is even greater. With decades of currency expansion and a much larger global economy, the next leg higher may require shifting the decimal point forward, reflecting a fundamentally different valuation range ahead. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.